The economy is going into recession. The number one reason to go into recession is the stock market going down. That is the economy now. Like, this is the beginning of the third 50% drawdown in the S&P 500 since 2000. I think this is the year I finally get to my $40 a barrel call in crude oil. I'm not a fan of gold. I think initially goes to 4,000. That I haven't said that in decades. I fully expect silver to go back to near 50 and gold initially to drop down to 4,000. I still think Bitcoin is going to head towards 10,000.
Stock markets are extending their 4-week sell-off today on Friday, March 20th, with the Dow Jones at yet another year-to-date low. The S&P 500 is down nearly 1% intraday as of around 12 p.m. Eastern Time. The Nasdaq is down 1.5%. Gold is back down towards $4,500, and Bitcoin is up to $69,500, and WTI crude oil remains at 96. This is the trigger for a major, serious recession this year that's going to bring markets much lower from here, according to our next guest, Mike McGlone, senior commodity strategist at Bloomberg Intelligence. We're going to be getting Mike's outlook on all of these assets and what the Fed is going to do next. This video was sponsored by Kalshi. It is a fully regulated platform that lets you trade on real-world events, from economic data to political outcomes. Sign up and use my code LIN, L-I-N, link in the description down below, or scan the QR code here. New users will get $10 deposited to your account when you trade $10. Traders can put money down on their favorite teams, events, elections, and more in all 50 states, including California and Texas, and over 140 countries. Mike, welcome back to the show. Now, the Strait of Hormuz closure probably didn't come as a surprise to a lot of people after the Iran strikes happened on the 28th of February, but not everybody anticipated those strikes to begin with, so it's understandable that risk assets sold off after the war began. But it's been almost 4 weeks now, so why are equities and gold, which we'll talk about, still selling off today, Mike?
Well, the most important thing, I think, as a trader, investor, and a strategist is admit where you're wrong first, own it, and move on. And I did not expect that the Strait would close. We fully expected the attack. I mean, most of it, there was an armada around Iran. That was just going to happen. It's a question of time. The market had priced for it, and crude oil was up on 20 to 30% on the year, pricing for that. Gold was rallying. Everything was pricing for it. The key thing that happened was I fully expect this to be quick, and the U.S. military would plan for maybe almost 5 decades, would not allow the Strait of Hormuz to be closed. Major mistake. It is closed. So now where do we move now? And that's where we are. This is the biggest shock for the market. It has inklings of 2008, 9/11 before that, and 2022 with Russia's invasion of Ukraine. And I've been just kind of kneeling towards what this means. So I fully expect it's going to be resolved soon. Maybe even this weekend, because I think what's happening is now is and the U.S. military and Iran and Israel militaries and there's let's not underestimate their intelligence services have messed up a little bit, but they're just going to, I think, keep pounding and pounding until Iran no longer has offensive capabilities. Now, we might see that by the end of this weekend. It's already kind of showing up a little bit in crude oil. You look at WTI crude oil. Last week, it closed at 98. As we speak on Friday, March 20th, or about midday, it's actually down on the week. Part of that is the flip in contracts. You went from that April contract, which still open, but it's basically done, down to the May, which is a 96 at the week as we speak. But that's part of the burden of crude oil. It has to be higher. It has to ride up the curve, and I have to look out. In commodities, we like to skate where the puck's going. If you go to that December contract, which is the most significant on the planet, partly because it's front month right before the midterm elections, it's running around $77, $78 a barrel. It's going to be front month right before midterms. I fully expect it to go towards 50. Trump needs it to go to 50. And it's a question, what's he going to do to make it go there? So right now we're in that fog of war. We have a long weekend coming up, but what's happening today is so significant, and partly from when you're seeing things like collapsing gold. I look at gold as looking ahead to a more secure world when we say the Strait of Hormuz is secure and Iran no longer has offensive capabilities to distress shipping there. To me, that's what's happening, but everything's getting hit. And I think that part of the reason is this is one of the best catalysts I've ever seen it's an energy crisis for a global recession. Now, you're seeing that in the industrial metals. Copper was up 15% on the year. Now it's down almost 7%. Silver was up 63% on the year, and now it's down a couple percent. You see the bent there? Silver's an industrial metal. Copper's an industrial metal. Yeah, and Bitcoin is, was already down 20% in the year. So to me, this is the year. And so I'll end with the key thing I've gotten wrong so far, but I fully expect to pick up is On the year, I pointed out some of those things are tilting over, but 60-day volatility on the S&P 500 as of yesterday was down 10% on the year. To me, that's a shocker. That happened in 2008, and the first quarter, first half, 60-day volatility. At the end of the first half was actually down, and then we saw what happened. So to me, this is an accident just getting started. I mean, it's a great tactically trading year, but I think for the key thing now is, can we avoid all this volatility from trickling over to the stock market? I think that's just getting started, which brings everything down, at least for now.
The stock market's been rolling over for 4 weeks in a row now, Mike. So take a look at my screen. This is the S&P 500. And as you can see, it topped around end of January, and it started rolling over even before the Iran strike happened. And so maybe, I'm not going to say it was telegraphing the Iran war. I'm not going to say that. But why was it already falling, basically, is my question.
It went up too much. To me, that's a key theme is the stock market bullishness at the beginning of this year and last year was probably the most extreme I've seen, to near similar peaks in 2000 and 2007. And the key thing is it had a good reason. All the indications were it was going to go down. First of all, gold warned us about what's happening now. Gold's parabolic rally to me was, I wanted to take a look back at it from the future. It's going to mean something. Now we know it's meaning something. Now we're giving that back. But also you look at what's happening in cryptos. There's a great leading indicator. They've collapsed. They're down. Bitcoin's still down 20% in the year. The Bloomberg Galaxy Crypto Index has rolled over. But what you showed in that chart is a nice rollover pattern. I started seeing that last year when I saw MicroStrategy getting too expensive. It started rolling over. And then Bitcoin and all cryptos starting rolling over. And now the stock market's just falling. And the key question is, where does it stop? To me, this is just getting started. We're definitely going to see some relief, short covering rallies. And that's what we've seen so far this month in Bitcoin, is a short covering rally. So everything's linked. Now, that's the problem is I look at, people here's one thing I like to end with. On the year so far, copper was up for a while, 15%, and right now it's down about 5%, which is almost exactly matching the S&P 500. See the problem? They're all the same trade right now.
So this is from Cowsheets, a prediction market. How high will WTI oil get by the end of the year specifically? So traders are predicting an overwhelming chance, 90%, 89% chance that oil will end the year above $100. And if you scroll further down, even at above $125, there's still above a 50% chance. Now, a couple things here. We're going to get to your deflationary outlook and revisit that call, see if you're still, thinking about that as a narrative. But also, I've heard some economists say that even if the Strait of Hormuz were reopened tomorrow, even if, let's say, the war ends tomorrow, the disruption to the supply chain has already been done. It's going to take several months to recover. Ships are now rerouting to all over the place, and it's going to be expensive to just go back to normal right away. And it's not just oil that's being disrupted, by the way. It's all sorts of cargo that runs through the strait. And mostly it's Asia and Europe that's affected. So, can you just comment on these odds here?
Sold to you. For crude oil to be that high by the end of the year, first thing has to be stated, it's different this time. Crude oil right now is kicking over to a global energy crisis and recession. The last good example of that, we had a little bit in 2022. The high was 130 and the low this year was 55. We had the high peak in 2008 at 147 and the low that year was 32. I see parallels, so I'll make my call right now. By the end of the year, by the time we get the elections, crude oil is going to be closer to 50. That's that front month contract. Right now, the December contract, which will be front month in a few, by the time we get to those elections, is 77. And for that to happen, that scenario towards $129 a barrel, that's a global recession. That means the Republicans get absolutely crushed. Trump's legacy is ruined, means the whole Middle East is a major problem. The Hormuz Strait is still closed. And please people always underestimate human ingenuity. The last time we had a similar pump like this in 2002, in China, maybe your average EV sales are 10% or so. Now they're 65%. These kind of things spark that bring on of that supply of crude oil, which is happening in the U.S. massively, the whole Western Hemisphere. It crushes demand, and then it brings out alternatives. So I'm going to say here, I'll make my call. I think this is the year I finally get to my $40 a barrel call on crude oil, probably on the back of one key thing, just a bit of recovery in U.S. stock market volatility. So right now we're in the fog of war. This is that scenario is basically expects the U.S. and Israeli forces, and they're increasing some of their allies because Iran has been reaching out and pissing off some of his neighbors. It fully expects them to completely fail and basically mentions that Iran's probably going to be in control of the strait. I think within a few weeks, the U.S. is going to pound them hard enough to say they don't have the offensive capabilities. That was a major mistake that they closed it, but we'll be opening that strait. This will be reset. And then the thing is, we already set it heading, just like in 2000. In 2001, we got 9/11. We're already tilting lower in the market. That event happened and the whole world headed towards a recession on the back of one key thing. Stock market went down. So I have to end with this. This event has happened with U.S. stock market about 2.3 times GDP. In 2007, before the last big pump, and before we peaked in crude oil, it was 1.2 times GDP. Also, 180-day volatility in the stock market is still running near a 10-year low. Well, just starting to revert. Also, we were warned about this last year by gold. So yeah, I'd love to take the other side of that trade. And let's make sure we check in by the end of the year. If I'm wrong on that, this is going to be, I already think it's going to be a great trading year, but that's a pretty severe global depression, that kind of crude oil price by the end of the year.
$50 or even $40 dollars a barrel. So yeah, that is going to be on the back of some sort of recession. Is that going to be triggered by ironically higher oil prices right now?
Yeah, exactly. So let's put it this way. It did it in 2008. It's natural gas has already done it. Natural gas was up 100% on the year. And that's a front contract. Now the front contract is down 16%. Silver has already done it. It was up 63% on the year, and now it's down 3%. Gold was up, a third on the year? Now it's up 5%. Copper was up 15% on the year now. You see the tilt in commodities? Pumps, then dumps. Right now, it's crude oil's turn, but here's the difference. In 2008, when the average price of gasoline reached $4 a gallon, that's when I just laid in the shorts. And I was trading then. I don't trade anymore, and made a decent amount of money on shorts in the stock market and everything. But it was up 53% to get to that. Our high so far this year, to get to that high of 120, was up 108%. It's double what we did in 2008. And that accelerated that great recession. So don't ever underestimate crude oil is the greatest. It's its own worst enemy. It pumps, it brings on supply, curtails demand, tilts the world towards global recessions, and then dumps. That's the scenario I think we're going to have this year. The key thing is this strait's going to be cleared up. Crude oil is probably going to collapse. At some point, we're going to have a relief rally in risk assets. And then we're going to look over and say, oh, look how expensive we were. Now we have this a more secure world. But before this was happening, we found out how expensive the stock market were. Consumer sentiment was waning. What's going to happen now to consumer sentiment? And then we have to tilt over back to, AI really created this massive pump in stock market valuations. Now everybody's worried about losing their jobs through AI. It's just, to me, this is a classic cycle. I think this year is going to make and break careers. And my main suggestion is to still hide in treasuries and look for levels to sell. So the key levels I've been using is Bitcoin initially was around 100. It got to 96. Now it's down at 70. Okay, that's a little bit lower. Copper above 6, that to me was a key short. $6 a pound. Silver above 100 to me was a key short still. As crude oil now, I think that high 120 is going to last for a long time. And even the bond yields, that's the key thing that's kicking it out. Treasury bond yields, that long bond right now as we speak is 4.95. The high for the year is 5%. It has been unable to go above 5%. It might get there again, but that's the lose-lose. If that goes up, everything goes down. And I fully expect by the end of the year, the best trade this year, I still stick with it, is I think what's going to grab alpha this year is the long bond. I see this as a combination of 9/11, 2008, and 2022 all together. And the big differences is stock market, as of a few months ago on a year-end basis, was the most expensive since 1928 versus GDP.
Combination of 2008, 2002, and
9/11.
All right, I'm going to come back to that call. I want to play for you this clip. The reporter asked Powell at the latest FOMC meeting earlier this week about oil and its impact on Fed policy. Take a listen, and I'll get your take.
There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So First, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between a half and three quarters, is actually tariffs. So
is he trying to say that oil is going to have a rollover effect or spillover effect on other commodities and other assets here? What's he trying to say?
He doesn't know.
Okay.
He doesn't know. And I want, if I can, I'd love to share a screen, or I can just talk about it.
Please go ahead.
And as I shared, in 2008, I just remember trading it well. CPI peaked right about here as the things were collapsing at 5.6%. That's when crude oil reached $147 a barrel. And the Fed had already started easing. The Fed just stayed stable right about 2%. Actually, the Fed funds was closer to, But this year, now we're hovering below 2.4%. It might spike above 3%, but this is when rates are higher. And the stock market cap to GDP is double what it was then. Back then, it was like 1.2 times. Now it's 2.3 times, 2.2 times. So to me, this is a scenario that's going to make 2008 look like sissy stuff be compared to what's happening, because we're just so stretched. But right now, as we speak, the Fed has just started, the market has just started to inkling, for the first time I've seen in years, potentially price for hikes, which is, you're seeing it on the screens. Everything's getting hit. To me, that's an oxymoron. You don't hike in this environment. You wait it out. And back in 2008 was an example. We just see that flat line. That's just Fed funds. They waited it out, and then bam, everything collapsed. So we'll probably see we're going to see a jump in CPI from this. It's hovering below 3%. It hasn't been able to get above 3%. Yeah, core's high, but I fully expect this number to be closer to zero by this year, if not next year. And it's not profound to say that, because all it needs is a little pickup in stock market volatility. Normal reversion to commodities already happened. I pointed out all the ones that have gone from major pumps to dumps. And it's done it before. So we were about 2% in 2020. We dropped below 2%, 0% in 2015. And we bought it minus 2% in 2009. This is a similar trajectory. So this is it's only March, David. So this is just getting started. And the bottom line for this, the Fed to ease, for inflation to go down, and for this to just have a normal pump then dump, is the stock market just, gosh help us if we have a 10 to 20% correction. Right now, we're down 5% on the year.
Isn't that exactly what happened with the ECB in 2008? They actually raised rates. If you take a look at my screen, I'll just show you real quickly.
Yeah.
This is the ECB deposit facility rate for the euro area. In 2008, right before the Lehman collapse, they raised rates once, and that was because oil has been going up, like you showed in the chart, all throughout that summer, and the inflation reading in the euro area stayed hot. In retrospect, I just remember. Yeah, please go ahead.
I remember that so well, because I started getting bearish at the end of 2006. I had a rough year trading in 2007, and obviously did very well in 2008. I thought I was just hedging my life and my home and everything, because I saw it coming. Volatility was too low, but that was one of my triggers. Spike in oil prices, ECB hiking, Fed figured it out, but that was just dumb. It's one good way to accelerate a recession when you already have kind of an oil shock is to hike rates. And they're already starting to price for hikes in Europe. So this is the big one. And it's not really profound to say that at all, David, when I point out two things. Last year, we had the best year for gold since 1979. That's making it look a little more profound right now. And we have the highest, most expensive stock market versus GDP, I mentioned, in almost 100 years, and stock market volatility is still low, and Bitcoin's collapsing. It's all telling you that this is going to happen. Just button down and act accordingly.
I bring up the ECB because that's exactly what the Fed is contemplating right now. Recall at the FOMC conference, there's been several questions asked about the possibility of a rate hike this year because of what's going on with the Strait of Hormuz. This is from Kaushi again. Prediction markets are saying there's a before 2028 63% chance. Before 2027, there's only a 15% chance. All right, it's still not high, but it's going up. Before July 2027, there's a 35% chance of a hike. So it's not high, but it's not. It has been going up. I'm not saying it's going to happen, but if they contemplate a hike or execute one before the summer, or even just keep rates steady, what happens to the economy? What happens to markets?
The economy's going into recession. The number one reason to go into recession is the stock market going down. That is the economy now. Like I said, it's the highest versus GDP in almost 100 years. Just imagine a 10% correction. That's almost 25% to GDP. Mr. Trump talks all the time about, trying to get Europe to increase their percentage of GDP to 3 to 4% for defense spending. I mean, you can't delegitimize that fact, but I would look at that as a strategist is like, oh boy, you're going to add fire to a global recession. And I hope they don't. I think they're smart enough to what they did in 2008 to just wait and then ease. So my prediction is by the end of the year. And also that number will change the minute we see a secure Strait of Hormuz and crude oil can drop 20% in a day. I would say that quickly. And actually, my point is still it's going to be down a year. But then look at all these other markets. They're collapsing in commodities. Yeah. The only thing that's up left now is energy.
Okay, so before we get to the other commodities now, I do want to talk about gold and silver and Bitcoin. WTI is at currently 96 and Brent is above 100. If you were an oil trader, would you pair trade this somehow, like short Brent, long WTI?
Well, that's what oil traders are doing. But if you go out, you don't ever do the front month. You go out, I would go to DEES, and that spread's about normal. So right now, at least I checked it yesterday, that spread between Brent is, it's high, but historically it's gone much higher. And it has a great reason to be high. I mean, Brent represents global seaborne crude mostly, and WTI is still somewhat landlocked. Now that's changed. But remember that in the whole history of crude oil, I like to point out there's one key thing. Look at Brent as a bell curve. Every time it gets above 120, it drops down to 40. Now that's 20 years of trading, and a whole period of time, and the bell curves and the apex is around 70. That whole period of time, the U.S. was most of it as a net importer. Now we're a net exporter. Add in Venezuela, Argentina, Canada, Brazil, Guyana. The supply coming out of the Western Hemisphere is going to balloon from this. I mean, the landman, we're just waiting for an opportunity to sell forward and bring on more supply, which is going to trickle down. So I'm quite confident that this is the pump that's going to dump. I've already seen it happen in natural gas this year. And give me a month and I'll get worried, but this is going to, I think let's not underestimate the tenacity of, first of all, our president. I've learned not to underestimate him. The U.S. military, combined with the Israeli military and those combined intelligence sources, the key thing I learned is you don't mess with the Mossad. And these guys, when people talk about boots on the ground, they'll figure it out. The bottom line right now, number one goal is capitulation from Iran, to eliminate their ability to cause distress, to keep the strait closed. That, I think, by the end of this weekend, very soon, will be mostly secured, and we will have a better clue. But this is, sometimes a great peak. And also I like to point out is if it's so bad, before a weekend is usually the problem. But why is crude oil down in the week? It's 96. Last week's close was 98. Okay, so by the end of the day, it might be higher. But that's the key thing. When you come in Monday, and if there's not any major damage from Iran, it can be seen that Iran is just inability to really create offensive distress. Crude oil is going to start collapsing. The key thing is gold's already warned us about that. Gold is already looking forward to a more secure world. And here's the reason I'll pause and we'll go there when you're ready.
One final note about oil, and then we'll go there. So this is what you were referencing earlier. It spiked, oil spiked, and then recessions happened. Hasn't happened every time in history, but it's happened enough. 2007 to 08, we talked about. 2001, 1991. I think that was a Gulf War. So
I was in the trading pits. I remember that one well.
I don't know if the recession had anything to do with the Gulf War at the time. Maybe you can brief us on that. And then 2020 was COVID, so it actually went the other ways. But that was an anomaly. Barring COVID, which was an anomaly, why do these relationships happen here?
It's the most significant industrial commodity, less so than in the past. And one thing I like to point out, when it spiked in 2022, I so enjoyed writing about the lessons of Adam Smith and the invisible hand. And this is happening during a paradigm shift. We're shifting of converting fossil fuels to technology. Right now, we have 100% tariffs in this country on BYDs, electric cars from China. Why? Because they're awesome and they're cheap. And before that, in 2022, maybe average sales in China were 10% electrics. Now they're 60% or so. Why? Because there was a shift in incentive. It's not underestimate human ingenuity and necessity and invention. And that's what's going to happen. That is happening. And you're seeing it definitely in the U.S. All I see right now is those producers who here's one way to look at it. That's calling a recession for the rest of the world, which is a big problem. And you can see that also from China and Europe. And let's look at Germany. They haven't had really positive economic growth for almost 5 years now. But what this is doing in the U.S. is accelerating what was the U.S. becoming the dominant energy producer in the world. Now, it already is the biggest energy producer in the world and a net exporter of natural gas and crude oil. So what do you think this higher price is going to do for all those producers who started curtailing production? Sell forward, bring it on. What's it going to do for demand? It's going to collapse demand. Maybe that collapse would decline it. So one key thing I like to mention, the average price of a gallon of gasoline in this country has popped up to near 4. In 2008, that was my signal to sell. Now, the high got to 5 in 2022 and came back. Right before this happened, it was running around 2.5. The average price of a gallon of diesel gasoline has popped up just above 5. The high was just about 5.80 in 2022. That's the grease of the global economy. So right now you're in those spikes, but they're going to be, and the market was so ready for a catalyst for reversion is the way I like to point it out. And the key thing I like to point out is we have 180-day volatility on gold reaching the highest since 2009 and 180-day volatility on the NASDAQ and S&P 500 almost near 10-year lows. That's going to pick up, and that's going to be your main signal.
The idea that oil going up would cut consumer demand, I understand that as an economic theory, but in practice, how much of that actually happens? In other words, how much of consumer demand actually falls when gas prices go up? And I know more people have EVs now, not everybody does, but is that effect still as relevant today as it was in the early 90s?
I think it's much more now because of the psychology and human and consumer. Consumers are already getting somewhat upset, unpleasant, unhappy before. Consumer sentiment was pretty negative before. Now we've got a great catalyst to say, oh, hey, honey, shut up the spending. We're not going to buy that extra car thing. And also, this is in the back of the biggest money pump in history. I've been waiting for this. I've been way too early. And now we have that signal to just shut off the consumer globally, not just the U.S., most notably in the rest of the world. But it's happening. The number one way to really pressure consumer sentiment is gas prices going up and the stock market going down. Now, that's what we're seeing right now. So when we look at the data a few months from now, from this period, it's going to be horrible. Now, we're going to know that. But also from a few months from now, we're probably going to see crude oil closer to 50 than closer to 100. That's my view. And then you're going to see all that easing. The bottom line is, when the stock market starts going down, which is way overdue for just a normal reversion, and it was up 20% 3 years in a row, it's way overdue for a 20% correction. David, that's going to be all that matters. And that's where we have a classic case of a post-inflation deflation cycle. Right now, we're inflating a little bit, but some of us remember this as well in 2008. In 2000 and some of it in 2022. So right before this happened, crude oil is trading around 55. I think we're going to go back to that. Yeah,
this is kind of reminiscent of 2022 when the Ukraine war broke out and oil temporarily spiked to above $120. Stock markets were already rolling over because the Fed was on a hiking cycle. I'm just going to call this if they consider a hike, or if they actually do a hike, it's all over for the markets. We're looking at 2022 over again, but maybe it doesn't even need to take a hike for us to get there. Maybe the natural order of the recession that you're calling is just going to make the markets go down. So what's going to happen now with gold and silver? You wrote about this in your most recent piece, 2026, a sell Q1 buy fourth quarter silvers, Q1 pump then dump may prove contagious. All right, we're calling this the devil's metal.
Yeah,
and
I'm not. That's the mantra. That's the nickname I heard decades ago for silver.
Right. Yeah, that has lived up to its reputation, reversing a 63% year-to-date gain on January 28th to a roughly 1% decline on March 19th. Now, let's just start with gold. Silver has been kind of tracing gold. The notion that gold is supposed to hedge us against geopolitical uncertainty, I think a lot of gold investors have been disappointed with that ever since the Iran war broke out on the 28th of February. The DXY, the Dixie's been rising as a safe haven, and gold's been going the other way. Can you comment on that first?
Gold was the right trade to be in last year. Some of us got lucky. I never thought it would go up that much, but it's its own worst enemy. The highs, I'll stick with my key theme for this year. The highs in gold and silver might last for years, maybe even decades if history is a guide. It just went up too much. And the key theme is that it flipped. It switched from a store value. Typically, store values trade with volatility less than the S&P 500. It jumped to 180-day volatility, running 2.4 times the S&P 500. That's not a store value. That's a speculative risk asset. It's a classic you're supposed to be selling when you're yelling. I'm not a fan of gold. I think initially goes to 4,000. I haven't said that in decades. David, I started saying it last year, like cryptos in 2024. I was early, peak 2025. Been early in metals, but I fully expect silver to go back to near 50 and gold initially to drop down to 4,000. There'll be buyers, but I think this is the end of that bull market. It's over.
Where's the bottom for you?
I don't know for sure. The bottom is going to really depend on the stock market. If this is what I think this is, the beginning of the third 50% drawdown in the S&P 500 since 2000. We've had two, so it's not profound to say that. The only thing is it's just so anathema to say that people can't even conceive of a 50% drawdown in the S&P 500, which would be approximately it's about almost $30 trillion. That's
wow.
100 times GDP. That's 100% of GDP. It's just a normal reversion. We're way overdue for it, and this to me is a catalyst.
Let's take a look at 2001, 9/11, and 2008 as just a reference, and we'll close off there, because that's what you're saying we're getting a combo of. So what happened with gold? What happened in the S&P 500 during those times? 2008, we know what happened. Everything got slammed. 2002, I'm actually curious, what did gold do during the tech bubble? It actually was in a decade. Yeah, it was a decade bull market. And then 9/11, what happened immediately after 9/11? My gut instinct tells me after 9/11 was, that was not much. That was still in the bull market. So, is it fair to say that gold isn't going to react too much to the stock market volatility here? Because that's not what happened the past three cycles.
So what I've been using is the word with gold. When it got above 5,000, I was early. I started really worrying about above 4,000 last year. It's a lose-lose. Stock market goes down. It's the bottom line is when you have any asset that trades much higher volatility than the stock market, unless it's a negative delta put, and stock market goes down, everything goes down, particularly high volatility assets. That's gold. Unfortunately, it's changed. It's the answers have changed, and also it got to a classic example of it just went up too much. And silver too. I think here's a key word you're going to be hearing in silver: thrifting. Now we've dropped a lot fast already from that high above 100. But the key thing, David, we all know is it's the hardest thing to do is when you've been bullish or long or strategist in an asset and it goes up a lot. Hardest thing to do is to stop and get out. And that's the human nature of it. And I'm got to be the one willing to walk in. I've walked in Bitcoin conferences the last year and I got booed because I said sell. I've heard that in precious metals for the last 6 months or so. And I'm just got to get used to it. But that's when you know you tweak something. When people's emotions get that strong, it's just the key lessons in markets is you never want to buy a commodity after it goes up. Gold is the least elastic, but you got to get in it before if you're bullish or broad commodities. But after it goes up exponentially like this, just remember what commodities do. Now, gold is less of like a supply-demand deficit, but most of the metals were in supply-demand deficits, particularly silver and copper, before this happened. But when prices go parabolic, it shifts the supply-demand curve. It brings on the supply, curtails demand. And that's the key thing a lot of analysts miss.
All right. Finally, real quick before we go, Bitcoin. Hovering around 69,000. Is this the local bottom here?
No, well, sure, it's been a bottom. The key support was around 60, 64. That was my key level. Key resistance is 75. I still think Bitcoin is going to head towards 10,000. The bottom line for that is the stock market going down and having at least a 20% correction. And partly because Bitcoin led the way up and it's leading the way down. I think initial key support now after this is around 50,000. I'll be worried if I'm still, the bottom line is also, it's a bear market. Respect it. Sell rallies. I don't understand what people are missing. The key thing I look about Bitcoin is there is an unlimited supply of cryptocurrencies. Yes, we all get Bitcoin is supposed to have limited supply, but now it's in the mainstream. It's been financialized. ETFs are on board, and it was the best sell signal, David, I ever seen. We had the best performing backtest asset in history, the biggest ETF launch in history. I can't wait to put that in my book sometime. You put it in the peak, it's going to continue to lead the way lower. So those are my levels. I think it's initially level. It should expect it to break down to 50. I think it doesn't really bottom to around 10,000. And that also predicates in the back of my view, the stock market. We're due for a pretty significant drawdown, and Bitcoin just led the way up. Should lead the way down. But the key thing is there was one in 2009, and now there's billions of these cryptocurrencies. It's an unlimited supply asset, and there's just too much purging that still needs to be done. So key thing is things like Dogecoin, still worth $15 billion. They attract nothing. Come on, we got to purge that stuff.
Thank you so much, Mike. We appreciate your thoughts. We appreciate your time. Tell us where we can find you.
On your show, thank you very much. On the Bloomberg terminal, at Mike McGlone 11 on X, and Mike McGlone Senior Commodity Strategist on LinkedIn. And if people wanted me to add them to the distribution list, just reach out. And thank you, David, for having me on. I'm looking forward to our next conversation.
I look forward to it as well. Have a great weekend. Enjoy.
You too.
Happy Friday afternoon, and we'll see you next time. And thank you for watching. Don't forget to like and subscribe. And don't forget to use my code LIN when you sign up to Kalshi. Link down below or scan the QR code. By using my code LIN, you get $10 when you trade $10. Link down below or scan the QR code here.